Hey everyone, let's talk about investments. Now, most of this set of lectures is going to be fairly mathematical, but it's important to remember as we get deeper and deeper into the math and the lectures that'll follow, that what the math is really trying to do is it's trying to represent a much more sort of soft and human market, if you will. A market is an interaction of rules, regulations, rational and irrational expectations, and fears and hopes by investors. And so before we get to the math, let's talk a bit about the underlying terrain, things like nomenclature, what different terms that we use to talk about the financial markets mean, and what some of the regulations in the way that we've set up financial markets actually are, which will set the playing field that we can then try to explain using math in the lectures that follow. So this lecture is going to be out of Bodie, Kane, and Marcus chapters 1 through 3, and it's going to cover the difference between real and financial assets, the different asset classes that make up financial assets, and where these financial assets live, so to speak, where they're traded, which is to say the difference between a primary market versus a secondary market. So let's begin with the difference between real and financial assets. Now, real assets are something that has inherent productive capacity. What does that mean? Well, think of like an apartment. You can live in an apartment, and that has productive capacity for you in the sense that it's creating value for you. Or if you own an apartment, you can rent it out to somebody else, and then they will pay you cash flows in the form of rent, and that would be another example of the same underlying physical entity, the apartment, producing value in a different way. But literally anything, a factory, a building, an idea can be a real asset. Now, a financial asset is a claim on a real asset. So an obvious example would be stock ownership. Remember, the owners of stock effectively own the firm, and therefore all of the machinery, buildings, and ideas that the firm actually uses to directly create value are owned by the stockholders because the financial asset that we call a stock represents a claim on these underlying real assets. But that means that these financial assets don't directly contribute to productive capacity in and of themselves. You can't really do anything directly with the stock since it represents a claim on a certain amount of real assets owned by the company in which the stock is held. You might get regular dividend payments out of it, you might get capital gains out of it, but the stock itself isn't generating those. It's simply conveying them to you because it is a claim on underlying real assets that make up the actual physical company. So they don't contribute directly to productive capacity, but of course it's important to remember that at one point the financial assets, be it debt, be it equity, were sold in exchange for cash that was then deployed to actually finance some real assets. So they do contribute, they just don't contribute directly to productive capacity. So some examples of real assets are land, buildings like we talked about, machinery, but increasingly, especially in the case of US firms, intellectual property as well. Now, unlike all these others, intellectual property is intangible, right? You can't actually grab hold of an idea. But if you look at the gains to many companies, especially the ones that make up the NASDAQ, the tech companies, many of them really derive most of their productive capacity, the value that they generate, out of the ideas that underlie their operating mechanisms, the way that the programs that the companies have developed actually operate, that will ship things to you faster, or route your payments faster, or run your operating system, run your phone. In other words, ideas, while intangible, can be tremendously valuable. And a financial asset can be a claim on those ideas, just as it can on the buildings where the ideas may be housed and the computer servers on which those ideas are effectively implemented. Now, examples of financial assets that we briefly touched on already are equity and debt. So debt is a contract that promises a fixed rate of return, and it's maybe backed by real assets in the sense that if the person who promised you that regular interest payment can't pay up, perhaps you can come in and seize some of the real assets. But equity primarily represents the ownership of the real assets in the firm. It might entitle the owner to some dividend payments, but mostly what equity represents is literally ownership of the underlying company that owns the real assets. So if a financial asset is a claim on real assets, let's describe in a bit greater detail just how different financial assets actually interact with the real assets. So for fixed income, which is to say debt, as we were saying just a little bit ago, it essentially represents a fixed stream of income, which is to say interest. Or sometimes it can be income determined by a specific formula, for example, a certain premium above the market rate of interest. So the interest rate doesn't have to necessarily be fixed. It just has to be deterministic. That's sort of the fixed part of fixed income. It's knowable in advance, or at least the rules that will govern it are knowable. And that, of course, is the entirety of debt assets. Whereas equity represents an ownership share in the company that owns the real assets. So a good example of that is common stock. That might, as we were saying, entitle you to a dividend payment, but primarily what this is literally just the ownership claim on the company, provided that the debt claim is already satisfied. So generally, the debt holder comes first once their interest payments are paid off and once they're due their principal. In other words, the face value of the bond is paid to them as well. What remains, that belongs to the equity holder. Now, a third class of financial assets that is going to be actually quite important in the later part of this set of lectures is going to be derivatives, which is to say these are financial assets that provide payoffs that themselves are determined by the prices of other financial assets. So you can view that as sort of another step of remove. A good example of that might be a option on a stock. Now remember, the stock is a financial asset that represents a claim on the real assets of a company, and a derivative is a financial asset that gains value or loses value depending on the value of that stock. Now we'll talk more about options as well as futures in a little bit, but those are examples of derivative financial assets that relate to the prices of other financial assets. So let's go through these asset classes in more detail now. Let's begin with fixed income. So the three main asset classes that we outlined are fixed income, which is to say debt, equity, which is to say stock, and derivatives, which is to say things like options. Beginning with fixed income, let's talk about the two main components of the fixed income asset class: money markets and capital markets. So the money market is a subsector of the fixed income market, and it is characterized by the following. Firstly, it's short-term. In other words, the debt assets that trade in the money market are all short-term assets, by which we mean less than a year in maturity. In other words, there's a year or less remaining between the time you first buy the money market debt instrument and the time when you get all of your money back, plus whatever interest this financial asset entitled you to. Now, this goes hand in hand with the idea of liquidity. Generally, people don't like to lock up their investments for long horizons of time, or at least they prefer not to. So there's more people who want to trade short-term bonds than long-term bonds. And so by liquidity, we don't mean it in any sort of moisture sense. We literally mean that money market debt is easy to get in and get out of. There's always going to be another buyer down the road because a lot of buyers want to invest in the short term, fewer want to invest in the long term. So any buyer should be able to more easily find a seller if they want to liquidate their position in the money market than in the capital market. And that goes hand in hand with lower risk. So if you can get out of your position more easily, that means that you face less risk of things going really badly. And also, if there's a shorter time horizon in your investment in this debt instrument, well, then there's just less room for anything to go wrong, for the company to go bankrupt, for it to get into trouble, for there to be some scandal that prevents the company from actually making good on this fixed income commitment to you. So money market debt is short term, it's liquid, and it has low risk. Now that comes with large denominations. So something like a repurchase agreement, these are generally large sums, but there's other types of money market components, specifically money market mutual funds, that will then hold some of these other more large denomination short-term liquid debt instruments, and then make them accessible to investors of all sizes. So while an individual person may have a hard time buying a certain amount of, let's say, a repurchase agreement, and you can see that that's actually a large part of the money market, what they can do is they can simply put their money in a money market mutual fund, which will then hold some of these other components of the money market itself, giving the smaller investor equal access to these money market components, even if the individual denomination of the debt obligations in any of these can be large. So the components are federal funds and repurchase agreements, time deposits and savings deposits. Those may be more accessible. Large denomination, time deposits, of course, less so. T-bills, those are reasonably accessible as well. And commercial paper, all of those make up the money market, and all of those are held by money market mutual funds. So what are these things? Treasury bills, they're short-term debt of the US government, and the maturities that it comes in are commonly 4 weeks, 13 weeks, 26 weeks, which is to say half a year, or 52 weeks. Remember, generally, The money market is short-term debt, which is to say debt of less than a year to maturity, so that makes sense. And the way these are sold is they're sold at a discount to face value. Now, certificates of deposit are essentially a time deposit with a bank. You commit to give the bank your money for a certain amount, and in return, they'll pay you a larger interest rate than they would if you just kept it in a checking or savings account from which you could withdraw at will. So you can think of it as sort of like a debt instrument, because you are locking up your money for a certain amount of time, and in exchange you get promised a certain fixed rate of return, which is the interest. Commercial paper, analogous to that, is short-term debt issued by a company. So the treasury bill is short-term debt issued by the government. Commercial paper is short-term debt issued by a private firm, commonly unsecured. So that means that if the company does, for example, go bankrupt, well, there might not be anything for the owner of the commercial paper to really lay hold of directly, but maybe the company will be liquidated in a bankruptcy proceeding and they might recover something. But it's important to remember that commercial paper is unsecured. There's no pledged collateral behind it. Other types of money market securities are bankers' acceptances, which is sort of like an order from a bank's customer for the bank to pay a sum of money to somebody else on a future date. So again, you lock up the money for a certain amount of time, and when the time comes due, the bank will pay out that amount of money. And again, usually under a year. Euro dollars are a subclass of time deposits that are held by banks outside of the US. The euro term originated simply because initially the outside of the US part meant Europe, but now literally any bank outside of the US in any country in the world. And the dollar part means that this debt is still denominated in dollars. By the way, why does this happen? Well, one reason is that this type of deposit, even though it's dollar denominated, since it's held outside of the US banking system, is not regulated by the Federal Reserve, which generally regulates all of the US banking activity. Repos and reverses, they're short-term loans backed by government securities, which is to say things like treasury bills. And federal funds are very short-term loans between the banks. So, for example, any bank can borrow money from the Federal Reserve, maybe even just for one day, an overnight loan, so to speak. But in exchange, of course, the Federal Reserve or another bank will charge that bank a certain interest rate. So, speaking of interest rates, generally when we say interest rate, we also mean, or we also talk about, yields. Those two terms are essentially analogous. Yields mean compensation. And why do money market instruments carry a certain yield? Well, primarily because money market securities are not themselves free of default risk. Now, a T-bill is, of course, backed by the full faith and credit of the United States government, but many of these others, commercial paper, even certificates of deposit, any sort of deposit with a private institution is really only as good as that private institution is. So that means that there's some risk that this institution will fail, some, therefore, probability that the money market security will not be repaid when promised, and therefore some compensation necessary for an investor to be okay with bearing this risk, even though, as we said, usually it's quite small. So one way that we can measure default risk is looking at the premium for a bank certificate of deposit relative to the yield on a T-bill, or what we call the TED spread, which is to say, TED stands for Treasury Eurodollar. Remember, we talked about Eurodollar deposits as another type of money market instrument. Since that's a deposit in dollars but with a foreign bank, that's less safe than a loan to the US government. So when financial risk becomes higher, usually we see both of these premia, the premium on bank certificates of deposit and the TED spread, become greater. Mostly because there's more worry about these banks or other private institutions defaulting, maybe not as much about the US government defaulting. So that means that the difference in the interest rates both of these must offer grows to compensate investors who might now be more worried about holding these higher risk of default securities that are backed not by the US government but by some private institution. So if we plot this through time, if we look at the spread between a 3-month certificate of deposit and a treasury bill, we can see that certain big economic shocks, for example, the collapse of long-term capital markets or the 2008-2009 financial crisis, coincide with increases in the spread between the certificate of deposit with a private bank and the yield on a treasury bill. And primarily this is simply driven by higher fears of default in the security that's backed by the private company rather than by the government.